Hey everyone, welcome. We're going to do a quick run through of the big ideas from Chapter 1. Think of this as a preview to get you all warmed up for our deep dive into management accounting. Let's jump right in.
All right, let's start with a bit of a head scratcher. What if I told you that one of the biggest, most famous companies on the planet, we're talking Coca-Cola, actually figured out how to make more money by selling less of its main product? Sounds wild, right? But believe it or not, it's totally true.
So that's the big question. How on earth is that possible? Well, it's not some kind of magic trick. The answer is all about using a powerful set of tools that help managers make really smart, strategic choices. And those are the exact tools we're going to start unpacking today. So here's our game plan. First, we'll solve that Coca-Cola puzzle. Then, we'll draw a clear line between two different kinds of accounting. After that, we'll see how strategy really shapes a business, walk through a manager's 5-step playbook for making decisions, and finally, we'll get into the crucial role the accountant plays in all of this. Okay, so back to that Coca-Cola mystery. Here's the scoop. People started wanting smaller portions, for health reasons. So they were buying smaller cans. Now, you'd think that's bad news, right? Less soda sold. But Coke realized they could charge a higher price per ounce for those little mini cans. And guess what? The extra profit from those small packages more than covered the drop in total volume. That right there is a perfect snapshot of management accounting in action. It's all about making those smart internal moves.
All right, so let's put a real definition on this. Management accounting is all about giving managers inside the company the financial and non-financial info they need to make decisions and hit their goals. The key takeaway here is that it's not about reporting what happened in the past to people outside the company. Nope. This is all about looking forward and helping people inside the company shape the future.
To really get a handle on management accounting, it helps a ton to see how it stacks up against what you probably think of as accounting, which is financial accounting. They're both important, but they do very different jobs.
And this table just breaks it down perfectly. Just look at who it's for. Management accounting is for the team, for the internal managers making the plays. Financial accounting, that's for the outsiders, investors, banks, you name it. And the focus is totally different. Management accounting is about the future. What should we do next? Financial accounting looks in the rearview mirror. What already happened? And it has to follow super strict rules, like GAAP. That's generally accepted accounting principles. Okay, so management accounting helps managers make decisions. Great. But how do they use that to build a winning plan for the whole company? Well, everything, and I mean everything, starts with strategy. It's not enough to just have a bunch of data. You need a blueprint for how you're going to win in the market. At the end of the day, every single business has to answer one huge question. How are we going to win? How are we going to give our customers something valuable in a way that our competitors can't? It all begins with choosing a core strategy. Basically, you've got two main roads you can take. On one hand, you can go for product differentiation. That's about being unique, being special, offering something that people will pay more for. Think Apple. The other road is cost leadership. This is all about being the low price leader, offering good quality but at a price your rivals can't match. To do that, you have to be obsessed with managing costs. Think Southwest Airlines or, of course, Costco. And Costco is just the perfect example of this in action, right? You walk in and their strategy is staring you right in the face. The concrete floors, the giant steel shelves, the bulk packaging, every single thing you see is designed to cut costs so they can give you the lowest possible price. That is cost leadership in its purest form.
Now, to actually pull off one of these strategies, whether you're Apple or Costco, you have to understand your business inside and out, every single step. And that's where something called the value chain comes into play. It's basically a map of all the activities your company does to create a product or service.
Think of the value chain as the entire life cycle of a product, from the very first spark of an idea in R&D, all the way through design, production, marketing, and getting it to the customer, and even supporting them after the sale. By looking at each link in this chain, a manager can figure out where to cut costs or where to add unique features. A company like Costco, you better believe they are scrutinizing every single link to squeeze out every penny of savings.
So we've got a strategy, and we've got the value chain to help us analyze it. But how does a manager take all that big picture thinking and use it to make a specific call, like, should we raise our prices or not? Well, for that, there's a really clear, systematic process they can follow.
This is it, the 5-step playbook. It starts with identifying the actual problem. Then you go out and get information. Step 3, you use that info to make predictions. Then, based on those predictions, you make your call. And finally, and this part is so important, you implement it. See what happened, and you learn. It's a circle, a continuous loop of getting better.
Let's make this real with a quick example. Imagine the manager of the Daily News. They needed to bring in more money. That's step 1, identify the problem. She went through the process, gathered info, and predicted that she'd make more by raising the price of ads than by raising the price of the paper for readers. So she made her decision.
And now we get to step 5, evaluate and learn. You see, those first 4 steps are all about planning. This last step is about control. The management accountant puts together a report just like this, comparing the plan, the budget, to what really happened. And whoa, you can see ad revenues were almost $300,000 unfavorable or short of the goal. But here's the thing. This isn't about pointing fingers. It's about asking, why did this happen? So that the next plan, the next decision can be even smarter.
So finally, let's talk about the person behind the curtain making all this happen. The management accountant isn't just some bean counter locked away in an office. They are a true strategic partner, working side by side with managers to guide these big decisions.
And their work really boils down to 3 key guidelines. First, the cost-benefit approach. Super simple. Is what we're getting worth what we're giving up? Second, they think about both the technical stuff, the numbers, but also the behavioral side. How will this decision affect our people? And third, they know this super important secret. There's no such thing as the cost. You use different types of cost information for different types of decisions. But none of this works. None of it, without a solid foundation of professional ethics. Think about it. Managers are betting the company on the information they get. So the management accountant has this huge responsibility to be competent, to protect confidential information, to act with total integrity, and to be credible. It is, without a doubt, the bedrock of this entire profession.
So here's the big takeaway from all this. Management accounting is not just about crunching numbers. It is the engine that drives decision-making in an organization. As you get ready to really dive into this chapter, just remember that every number tells a story, and every choice we make helps write the next chapter for a business. It's all about shaping the future. So that leaves one last question. What's the next big decision you'll make?